Welcome to the B.F. Anderson Technical Report for September the 9th. Trend analysis or trend patterns or change of trend is a study to help us to understand prices. When I was in business school, we took many courses on investments, but the most important class I remember was statistics, commonly known as quantitative analysis or quants. And what you're trying to do with quantitative analysis is to improve the probabilities and possibilities of success. So one of the things with trend analysis that we pointed out last week was the use of moving averages. And there's almost an unlimited number of these types of moving averages. Now here, we have no moving averages on this graph. This is nothing more than a price graph of the S&P 500 going back to 1994. Bear market, dot-com bust, market dropped 50%. Bull market, however, ended with the housing bubble, which ended in a 50% decline, which was actually worse than the dot-com decline. So we have experienced in the last years, we have experienced two bear markets, which has been quite difficult for investors. 2009, we bottom. Interest rates come down, the interest rate stocks move up, the bond market moves up. Then for the last 2 years, we've moved sideways. Here's your Brexit low, and now we're breaking out. Now, if we move to the next graph and we take the same time period and we remove price and we replace price with the 50-day moving average compared to the 200-day moving average. Now, what you're looking for with trend analysis, you're looking for changes. You're looking for changes in trend, reversals in trend, things like that. So you can see here the 50-day, which is the blue line, during the bull market phase from 94 to 2000. The blue line consistently stayed above the red line. Now, you had a whipsaw in here. But what you're looking for is where you get a break in the trend where the 50-day crosses below the 200-day. Now you'll notice that during the bear market, the 50-day completely stayed below the 200-day for the entire period until you saw the reversal. So when this happened, bad things started to happen. And so what we're trying to do is just observe the changes. Now you can see here this was the bear market of 2008. So let's get more specific. Let's kind of take a microscopic look at this. So what you're looking for changes. If you look at the left side of the chart, which is 2000, 2001, if you look at the left side of the chart, it looks completely different from the right side of the chart. So when you remove price, what you're also doing is you're removing a lot of noise. So as you can see here, the 50-day consistently stayed above the 200-day. Then the cross came in November, December of 2000. So that was a change. You needed to note that. Because with the first graph where we showed the 50% declines, if you would have noted this, you would have done things defensively, which in our case, we would move more towards cash, cash instead of investing. So you can see here that the right side, the 50-day stayed below the 200-day the entire time. Now here is the 2008 drop. Again, the left side is different than the right side. So we're noticing change here. Now, if we kind of bring it a little bit closer to home on where we are today, you can see that back in 2015, it was, the 50-day was below the 200-day. We were in a bear market for all practical purposes, and it was pretty much a full-bore bearish look. So you can see here going into 16, the 50-day was way below the 200-day, and that was a full-bore bearish look. Now, let's bring it forward to where we are now. So as you can see, the 50-day basically bottomed in March, April, and then May broke above the 200-day. So now we are in a full-bore bullish look. So it's all about taking risk. And when do you take risk? this is the type of environment where you take risk, where you buy stocks. So, it's important to note. Now, here is another index just to kind of go through this concept. This is a concept. This is the Russell 2000, which is the small cap stocks. Full bore bullish look, 50-day above, 200-day below, both trending up. This is an interesting index. This is the semiconductor index. Very strong. In fact, I've looked at many indexes of many industries, and I would say the semiconductor index is probably one of the strongest indexes out there. And this is very growthy because this has to do with new technologies. Now, why would you then have to ask the question, why would the semiconductor index be in such a bullish mode? Well, usually it foretells, or the market is discounting, a future business cycle. So if you think, well, is it computers? Is it cell phones? I personally believe it's automobiles. I believe we're going to see autonomous automobiles sooner than we realize. Now, here is emerging markets. This would be China, Latin America, so forth. We're seeing a bullish look there. And then finally, let's look at the financials. You can see that they're starting to improve as well. So basically, in conclusion, what I'm saying is there's a lot of noise out there. If you turn on Fox News or you turn on CNBC, you're going to have different analysts telling you different things all the time. I think it makes more sense to pay attention to trend, and one of the ways of doing that is by using moving averages. We'll talk about this again in the future. Thank you.